Right now, as you're watching this, 17 U.S. states are quietly asking the same explosive question. Why are BlackRock and JP Morgan using American savings to build up America's biggest rival? These aren't fringe activists or internet commentators. These are state attorneys general and treasurers responsible for the pensions of teachers, firefighters, police officers, and state employees. They've launched investigations, screened subpoenas, and hearings into what they call a 10 trillion China bet, a bet being placed not with Wall Street's own money, but with yours. On the surface, green looks like a technical dispute: ESG policies, fiduciary duty, index construction, risk disclosures. In reality, it's something much bigger. It's the oldest pattern in modern finances here. Stage 1, a small group of financial giants accumulate control over other people's money. Stage 2, they use that control to shape entire economies while telling savers they're just tracking the market. There's Stage 3, they quietly steer ever more capital into the next rising power, even as the political system at home claims that power is an enemy. At Stage 40, when the geopolitical break finally comes, ordinary citizens discover their retirement funds have been financing the very system now positioned against them. We've seen versions of this before: British financiers backing American railroads as the British Empire declined, green. Wall Street money restructuring Weimar Germany, and then sitting in the shadows as the crisis birthed a monster, U.S. Green, and European banks shoveling capital into Chinese growth for decades while their own industries hollowed out. Today, with BlackRock and JP Morgan at the center of a 10 trillion asset management complex, the pattern is repeating, large enough to pull entire states into the crossfire. So what are 17 states really investigating? They're looking at 3 interconnected claims. 1, that BlackRock, JP Morgan, and their peers are using public pension assets to advance geopolitical and ideological agendas, including deeper integration with China, that may conflict with the financial interests and security of American beneficiaries. T2, green, that the sheer size of these firms, collectively touching up to 10 trillion or more in global assets, allows them to move capital in ways that shape geopolitics while pretending they're just following the index. 3, screen, that while Washington talks tough on China, Wall Street's largest gatekeepers have quietly bet the future on China's continued rise and are now facing political blowback from states that only recently realized what's been happening. As to see how we got here, you have to understand what a 10 trillion China bet actually looks like. It doesn't look like one giant wire transfer to Beijing, green. It looks like a million small decisions baked into the structure of global finance. Start with BlackRock. With roughly 9 to 10 trillion in assets under management at its peak, BlackRock is the largest asset manager in the world. Most of that money isn't its own. It belongs to pension funds, insurance companies, sovereign wealth funds, green, and individual savers using index funds and ETFs. When a state pension fund in, say, Texas or Florida hires BlackRock to manage an index portfolio, green, they're outsourcing glass capital allocation power, the choice of where that money actually ends up, to BlackRock's machinery. Now add JP Morgan. As a global bank and asset manager, JP Morgan not only underwrites deals and lends money, it also builds and sells its own funds, structures, and indices. Together, BlackRock and JP Morgan sit at the center of a network that channels many trillions of dollars through global equity and bond markets. When index providers decide that China should have a higher weight in emerging markets or global bond indices, BlackRock and JP Morgan's products are the pipes through which your money flows into Chinese firms and Chinese government debt. For years, this was sold as neutral, a political finance. We don't pick winners and losers, the story went. We just track the market. But the market doesn't define itself. Human beings do. When MSCI, FTSE Russell, and other index companies decided to include more Chinese stocks and bonds in their benchmarks, they were effectively telling trillions of dollars in passive capital. You now own China, whether you like it or not. BlackRock, JP Morgan, State Street, Vanguard, and others dutifully updated their funds. State pensions and 41 size rolled along, barely noticing. Politicians, when they noticed it all, applauded global diversification. Then geopolitics changed. The U.S. began labeling China a strategic competitor, then a threat. Tariffs escalated. Technology bans spread. Sanctions lists grew. The same Washington that had encouraged deeper economic integration with China for 20 years suddenly decided decoupling was the new wisdom, at least in speeches. But money doesn't turn on a dime. Trillions had already been wired via indices and funds into Chinese companies and state-linked entities. That's when the 17 states started asking uncomfortable questions. State attorneys general sent letters to BlackRock and other managers demanding answers. Are you prioritizing ESG and climate agendas over pure financial return? Are you steering capital into Chinese companies that may be tied to the CCP, the PLA, or human rights abuses? Have you fully disclosed the geopolitical and regulatory risks of those China exposures to the pension beneficiaries whose money you're managing? Are your voting and stewardship policies aligning with his national security and his state interests or with a private ideology? Some states went further. They accused BlackRock and others of effectively as boycotting U.S. fossil fuel companies through ESG while at the same time supporting Chinese firms that face no such political constraints. For them, this wasn't abstract. Green energy producing states saw a direct line between Wall Street's ESG frameworks, lower capital for domestic oil and gas, and higher relative growth for Chinese competitors. BlackRock denied wrongdoing. It argued that China is too big a market to ignore. Excluding China would hurt diversification. ESG is about long-term risk management, not ideology. They follow the law and their fiduciary duty. Legally, some of that may be true. Strategically, it misses the point. The core of the state's concern isn't whether BlackRock broke a specific U.S. statute. It's that as the biggest asset managers have become de facto foreign policy actors, without ever being elected, without clear democratic oversight, and while insisting they are neutral servants of the market. Think about what it means when a handful of firms can collectively move or withhold 10 trillion. When index providers raised China's weight in major benchmarks, it triggered hundreds of billions in new flows into Chinese state-owned banks, Chinese tech giants, Chinese industrial champions, Chinese sovereign and quasi-sovereign bonds, all under the banner of passive investing. When BlackRock launched the first wholly foreign-owned mutual fund business in China, it did so with the blessing of Beijing, even as U.S. intelligence agencies were calling China the chief long-term threat to American interests. When JP Morgan took majority control of its China Securities joint venture, it was making a bet that its future fee streams depend on integrating with Chinese markets. No matter what Washington says. From Beijing's perspective, this is perfect. On one hand, it gets capital, expertise, and legitimacy from the world's largest financial houses. On the other, it watches those same houses lobby Western governments not to get too aggressive with sanctions or decoupling, because that would hurt their own bottom lines. From the state's perspective, it looks like something else as far as Wall Street using Reed state pension money to deepen black box exposure to China. While line workers are never told their retirement now rises and falls with decisions made in Zhongnanhai. To really grasp the danger, you have to see the historical rhyme. In the late 19th century, as Britain's industrial edge began to erode, British capital poured into the United States. Railroads, steel mills, utilities, green mines, many were floated in London, paid for with British savings. For a while, this was hailed as a win-win. Britain earned higher returns abroad. America got the capital it needed to grow. But structurally, it meant this. British families were financing the rise of the very power that would eventually surpass the British Empire. By 1914, Britain entered a world war against a coalition that included rising industrial competitors. Its financial sector survived, its global dominance did not. The capital flows had been rational. The pattern outcome was not. In Weimar Germany, foreign, especially American, capital surged in during the mid-1920s under the Dawes Plan. Wall Street banks underwrote German bonds, lent to companies, and helped rebuild the economy. To investors, it was yield. To Germany, it was air. But when the music stopped in 1929-1931, foreigners pulled back. The Weimar system imploded. The political vacuum sucked in something far worse, again, rational flows, catastrophic pattern. Today, BlackRock and JP Morgan are not betraying America in a cartoonish sense. They are doing what financial entities always do when they are too large and too powerful. They chase returns within the system's incentives. The system's incentives, however, are now misaligned with national resilience. The U.S. built a global dollar-based architecture that encouraged capital to flow wherever growth and margins looked strongest. For decades, that meant pouring money into China. Now, even as geopolitics soars, the inertia of that architecture keeps pulling. The 17 states aren't really investigating whether BlackRock has an ESG slide deck or whether JP Morgan's China division has the right compliance forms. They are, at a deeper level, reinvestigating whether ours as America has ceded control over its own savings to institutions structurally incentivized to fund its rivals. I's or G, and that leads to the real question for you. Where is your money in this pattern? If your retirement accounts, index funds, or pension benefits are run through the big asset managers, then part of your future is already bound up with the success of Chinese state-backed firms you can't vote against, Chinese bonds whose risk you can't see, a geopolitical bet you never consciously made. You can disagree with the 17 states' politics and still recognize their warning, as you are not the primary customer in this system. You are the product, your savings are the raw material. Global finance is the machine. And the machine is optimizing for something very different than your local community's long-term sovereignty. This doesn't mean panic. Screen. It doesn't mean sell everything or never own a global index again. Serious thinking is more nuanced than that. It does mean you cannot afford to stay at the level of slogans, diversification, fiduciary duty, just tracking the market, while the world around you moves into a new phase of geopolitical competition. The real story behind why 17 states are investigating BlackRock and JP Morgan's 10 trillion China bet is not a partisan drama. It is a revelation that we are deep into stage 3 of a pattern where financial power has floated free of national loyalty, while rival powers make cold, rational decisions about how to use that fact. China understands the game. It courts Western asset managers when it needs capital. It squeezes them when it wants concessions. It leverages their lobbying power in Washington and Brussels to blunt policies it doesn't like. All the while, it pursues its own long-term strategy, technological self-sufficiency, regional dominance, and a world less dependent on the dollar. The 17 states, knowingly or not, have pulled back the curtain on part of that process. They've shown ordinary Americans that the same firms managing their retirement are some of the biggest engines driving integration with the country their own leaders call a threat. You don't have to accept the states' solutions to accept their diagnosis. Something is deeply misaligned between where American capital is going and what most Americans think they're supporting. And if history is any guide, misalignments of that size don't resolve gently. They resolve when reality forces a repricing of assets, of alliances, of assumptions. At that moment, the question that will matter most won't be which state sued which manager. It will be, were you holding the promise or the power?